Welcome back. This is Corporate Trader, and you're tuned in to CNBC-TV18. Well, let's focus on another number that did come out yesterday, HDFC Life. The management's next on the show. The stock is under some pressure after reporting its Q2 numbers. We're now joined by Ms. Vibha Padalkar, the Managing Director and CEO at HDFC Life. Hi, Mr. Padalkar. Good morning, and thanks a lot for joining in. Well, the street doesn't seem to be very impressed with those numbers. But importantly, what about the second half of the year? That's going to be important. So fill us in with a couple of numbers. One is the growth. What kind of growth projections are you looking at? APE growth, I think some on the street are expecting around 14-15%. So you could tell us what do you expect on that? And VNB margins as well. Last few quarters, because of a variety of factors, it's come down to around ballpark around 24%. Do you see it stabilizing around these levels?
Hi, good morning, Nigel, and everyone else on the panel. Actually, I want to deconstruct this into two parts. We had a fairly good quarter and we had a fairly good H1. We also delivered in terms of no surprises from an operating perspective. This is despite some of the external turbulence caused more notably due to the GST changes, which is largely welcome, but there would be a impact over the next couple of quarters. In terms of deconstructing why I'm saying we had a fairly good quarter is that we did see market share expansion, both in Q2 as well as overall in H1. In fact, the market share expansion in Q2 was even better at 100 basis points than the expansion of 90 basis points in overall H1, so versus Q1. Right. Also, the overall growth and hence was faster than the sector. All the right notes were hit in terms of retail protection growing at 34% in Q2. And as a result, sum assured also growing in the mid-20s. Embedded value, operating profit, new business margin, excluding the GST impact of 0.5%. So actually, there was a margin improvement underlying. And also in terms of some of the other metrics, whether it is in terms of new customers. So new to HDFC Life customers continued to be 70+%. These are first-time buyers of HDFC Life products. Annuity continued to grow. And more importantly, our agency channel, which we have talked about investing in, that also grew fairly well. Renewal premiums were robust. So really, it's a story of two halves with and without GST. But underlying performance is more than meets expectations.
Okay, all right, Vibha, you've given us a fair idea. And, the reason why you believe these numbers are good, market share gains, and also given the challenges, you're seeming fairly satisfied. But let's talk about growth. You could break it down, APA growth, retail growth. What kind of estimates are you working with for the second half of the year and what that means for the full year on the whole? And also VNB margins, my earlier question. Will it stabilize around these levels?
Yeah, on growth, what we have said is that it was a story of two halves based on the growth last year for us and for some of the larger players in the sector. So for HDFC Life, H1 last year grew by 31%. And also to remind your viewers that we had a withdrawal of the old surrender charge regime. And so Q2 growth last year was very robust. Like I said, overall H1 growth of 31%. So there's a large base effect, which then normalizes in H2. And hence, what we had mentioned is that growth this year will be in the early teens. We also are fairly coupled with whatever is happening overall in the macro situation, whether it is the political global turbulence as well as in terms of what's happening on job creation, savings rates, and so on. And hence the slightly more muted growth of about, like I said, early teens. So that's very much in the ballpark, maybe a month or so here and there, but fairly good. And we've also said that while we think it is going to be in the early teens, we will still grow faster if the market starts growing faster. And that's something that we have delivered on. In terms of outlook, no change in the outlook as of now. What we have said at the beginning of the year should continue, us continuing faster than the sector, and it will be in the teens.
Right. Just on the GST front, you did quantify that impact at about 0.5%, but that was just 8 days during the second quarter, right? On the third quarter, what could the impact be? And if you could, simplify that for us, how much would be the increased, sales on account of lower prices to the customer, and how much could there be an impact because of the lack of GST input credit?
Yeah. So the answer is in two parts here. One is on the back book, which we had quantified soon after the GST announcements were made, which we said it's unlikely to exceed more than 0.5% of our embedded value. And I'm happy to share that we are a shade lower than what we had put out because we put it out immediately, but bottoms-up calculations at policy level also gave similar answers and a shade better. So that has been articulated and it's there in our investor presentation. On going forward business, there are three components. For this quarter, so quarter two, there has been, like you said, 1 month's impact. It's strictly from September 22nd, but people did defer purchases of life insurance policy. So effectively, it's like close to a month's impact. And on quarter two, if I were to just have share the impact on three key metrics, our PAT looked anemic at 3%. But if I were to remove the GST impact, it would be closer to 15%, both for the quarter and for the first half of the year. VNB growth at 8% would have been 11% for the quarter and about 12% for the first half of the year. And finally, on margins, our margins as against 24.1% would have been 25% for the quarter, and as against 24.5% in H1 would have been 25% in H1.
Right.
So
Thank you for articulating that. And just before we toss to our colleague Yash, just one question on the ULIP front. You know, you wanted to bring it to sub 30%, but now it's still at 42%. What's your path to 30% here? And because it has an impact on your margins, right?
So a very good question, Nigel. And what we are trying to do is work within the system. And by that, I mean, unit-linked, like with equity mutual funds, continue to be, customers find it attractive. So rather than pushing back against it, we are trying to see how we can increase the profitability as well as suitability for more affluent customers. And so having higher levels of mortality cover, given that the avatar of unit-linked is something that people understand, can we give more than 10 times cover, which is a very low level of cover? Can we increase it closer to 50, 60 times cover? And that's really what we're working on. And we've made meaningful impact and inroads into that. And hence, if you were to look at our sum assured just for the quarter has grown by 26%, which is more than double our company level growth. And that really shows that mortality cover, that part of our business is growing fairly fast. Part of it is due to retail protection, but also meaningful part is due to higher cover within unit linked. So getting more profitable.
Hello, Vibha. Good morning. This is Yash. Answering to Nigel's question, of course, you did mention that you expect early teens growth when it comes to AP and VNB. But margin seems to be an important point here. In the last 3 years, FY23, 24, 25, the margins have receded every year by about 100 basis points. H1, FY26 to FY25, they are largely flat. Do you expect similar deceleration, that is of 100 basis points in margins, to happen in this year also? And at what point and by what time period do you expect stability as far as margins are concerned, or do you think a floor has been hit at current levels?
So I want to counter that slightly. I want to clarify that, Yash, because margins have not decelerated ex GST. So if I were to look at H1 margins last year at 24.6% versus a pre-GST margin at 25%. Post-GST is very close to last year's margins. So there are these two one-time impacts that have dented the core operating margins of the entity, which has been steadily rising. One is, as you know, surrender charges, which had a 0.3% impact on margins. And if you look at last year versus the year before that, so when surrender regime came in versus before that, it's really only the impact of surrender charges. Everything else has been neutralized by us in order to hold margins and also grow them. Similarly, this year, while the number of days that we're reporting after the GST changes are too few, 22nd September is when it has been rolled out. But what we have articulated is that we will get down to neutralizing the impact on margins. So we will close to hold margins and thereafter FY27, to answer your question, margin acceleration should happen, all things being the same. And when I talk about margin acceleration, just to clarify, even this year before GST, I had said that we will hold margins because we want to invest in two aspects. One is technology and second is our agency business. Despite the fairly a material impact of the GST changes, we are not winding down on those investments. They are investments for the future, because the easiest thing for us to do is to go slow or to retract some of the investments we need to make for the future. And we'll continue making that, because this is a temporary blip.
All right, Vibha, thank you so much for joining in and giving us your views on growth going forward, the impact of GST, your outlook on margins. And we wish you and your team a very happy Diwali and festive greetings as well.
Likewise. Thank you so much, Mangala.